Hey guys, how's it going? I'm Zack Hatcher and you're here on Zack's Corner. Nice to have you guys. So we're here at Linthicum, Maryland at one of our beautiful... Hey guys, how's it going? I'm Zack Hatcher. Hey, what's going on, guys? Welcome back to Zack's Corner. Thank you so much for stopping by. I appreciate the love and support. Appreciate the likes, comments, the subscriptions, the shares. I just thank you guys so much for the love. It means the world to me. Thank you so much. So today we're coming here, coming to you guys on Zack's Corner from this beautiful rent-to-own home here in Greenbelt, Maryland in the 20770 zip in the Lake Crest community. 3 beds, 3 baths. It's got 1 floor, 2 halves, 2-level townhome. It's beautiful, right? It's beautiful. So today we're gonna talk about something really cool, right? We're gonna talk about DTI. And for those of you guys who don't know, DTI stands for debt to income. So your debt to income ratio is just simply your monthly debt payments divided by your gross income. All right, so let's draw it out so that it's more simpler to see. We're just gonna use GI for income, and then it's DTI. And this number is gonna always be a percentage, right? So guys, this number, this DTI number, this is one of the measuring sticks that lenders use, mortgage lenders and auto lenders, and any place where you're borrowing money for something, whether it's a house, a car, whatever it is. That DTI is going to come in effect. So this is a number that the lenders use in order to measure your ability to make monthly payments on money that you have borrowed. That's why this number is super, super important. And today we're going to go over it for you guys so you can see how the numbers are crunched and crunch your own numbers and not wait for someone else to give you the answer, right? So to calculate this number, like I said, is really, really simple and easy. You just add up all your monthly debt payments and you divide it by your gross income. Now, we all know that gross income isn't the money that we get on our paycheck that we go to Walmart in cash or our direct deposit money. This is the money that the company pays us prior to our tax deductions and any other deductions that we have. So make sure you know the difference between that and gross income. So we're going to jump into some examples shortly, but I'm going to show you guys in a minute how it looks and how to crunch those numbers. So in reference to higher DTI, so when you have a higher DTI, it can give you trouble making your monthly payments anyway. So that's why of course, if you got a higher DTI, a lot of lenders won't lend on you to whatever particular thing you want to get lended on, right? And we'll break it down like this. This is your debt, this is your debt payments, and this is your GI, right? This is your gross income. Now, the funny thing about it, a lot of people don't know this, but mortgage lenders in the real estate industry, they lend on this gross income number. So they're not actually lending you what you're going to come home with. They're going to lend you on this gross income number. So that's why it's so important that your DTI be in the right space at a right percentage in order to get approved or pre-qualified for your mortgage, right? So we're going to jump into what we call in our industry the 43% rule. So the 43% ratio is super important because in most cases, that is how the highest you're able to go in order for an individual to get pre-qualified for a mortgage. Now, your DTI percentage will affect the amount of money that you are loaned or the amount of money that you're approved for, and it also will affect the interest rate. And all of that is important when we're talking about 30-year fixed rate mortgages, right? Your interest rate and your loan amount are super important in these situations. Like I said, so it will affect your loan amount and your interest rate. Different loan products have different DTI limits and lending criteria, and the same goes for different lenders. So please, whether you're in process of leveling up, about to buy your first home, or you're in process of leveling up, about to do your first investment property, whether that's buy and hold or fix and flip, guys, please make sure you talk to multiple lenders because each of them have different loan products and loan programs. So please make sure that you speak to multiple loan officers and multiple different banks just to get a gist of what they can do for you in your real estate goals in the future. Right? So let's go ahead and crunch some of these numbers so you can see what it looks like. And it's important to be able to crunch these numbers yourself because you don't want to sit around waiting on somebody. You want to be able to do, now you can't underwrite your own loan, of course, but you want to be able to make sure that the important numbers you can crunch yourself, right? So let's go into an example, right? So we got, let's say your rent is $1,500 a month. Let's say your car note is $100. Let's say the rest of your monthly debt for every month is $400. That's $2,000, right? And let's say your gross income is $6,000, right? So remember, to get our DTI, it is our debt payments divided by our gross income. So obviously in this example, it would be $2,000 divided by the $6,000, and that would give us a 33% DTI, which is really good. Remember, because like I said, you want to stay 43% or below. Okay, so let's throw up an example so you can see numbers wise what 43% DTI looks like. Okay, so we're not going to get into the specifics, but let's say that your monthly debt payments are $4,067. Let's say you gross $9,400 a month, right? And remember, this is a pretty good number, right? This means you're grossing over six figures. Now, what you're bringing home is a total different story, and we'll talk about that on another episode of Zack's Corner in reference to taxes, right? But you're making some pretty good money here. So this individual, you can pull out your calculators and do the math yourself. This individual's DTI will be 43%. Now remember, like I said, in most cases, there are you have to stay at this 43% DTI mark in order to get pre-qualified for a mortgage. Now there are situations where you can have a little bit higher and still get pre-qualified. And I'll give you an example of a young lady that I work with a few years back. We were able to get her a townhome in Waldorf and be able to get her approved. So I'll throw up her numbers so you can see exactly how her situation worked. Okay, so she had monthly debt payments of $4,500. Okay, she worked for a really nice company. She grossed $10,000 a month. Obviously, this is pretty simple math. Her DTI was 45%. So her lender, Navy Fed, was able to get her pre-approved for $230,000. She bought a townhome in Waldorf. Okay. Now, guys, please, every situation is particular. Not one person's situation is the same, right? Just how not one person is the same in this world. So that's why it's in most cases that 43% is where you want to be or below her. But like I said, each situation is different. Your situation may be like hers or it could be different. All right, so it's all particular based on your entire situation, right? So guys, I hope you got some value today. I hope you learned something. Please like, comment, subscribe, share. Let me know, comment in the comment section below something you want me to talk about. I love to talk about anything you guys want me to talk about. And you know how we do it, man. This is Zack's Corner. Peace!